Hello, hello, Dan Passarelli here. How are you feeling today? Before we get started, I want to make sure you can hear me. So please go and hit that Q&A box for me and say hello. Let me know you can hear me. We're all friends here. Hit that questions box for me. Q&A box. Let me know you can hear me. There we go. Hello, Steve. Hello, Ted. Hello, Teresa. Hello, Jerry. Hello, Yossi. All right. We've got a lively group here this morning. I love it. Okay. So today, hold on a second. We got to get to the first slide here. Today, we're going to talk about how to generate income using options. And before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you can't afford to lose. And everything we're talking about here today is generalized information, not necessarily specific to your personal situation. For those of you who are not familiar with me, my name is Dan Passarelli, and I am an author of two of the most popular trading books on option trading. I am a trader. I spent many years as a professional trader on the floor of the Chicago Board Options Exchange, standing down in the pits, yelling and screaming. And now I trade in a retail trading account just like you. I'm also the founder and president of Market Taker Mentoring, which is the global leader in option trader education. And I'm a trading industry collaborator. I've worked with just about every options broker globally, as well as just about all the options exchanges. And I'm a family man. Those of you who are Market Taker students are probably familiar with Kathleen, my wife, my two adult children as well. And I do some things for fun and health. I'm a runner, I'm a foodie. Sometimes those two contradict each other as far as health goes, and a traveler, and I'm a music person as well. Now, I want to not so subtly bribe you into enjoying this presentation. So here's what I'm going to do. If you go to markettaker.com, it's market as in stock market, taker as in take what's rightfully yours, two T's in a row, markettaker.com, and go up to the top right and click on join free. You can join free, and you can get some free courses. You can join our chat room, which is free at the moment. And we will welcome you with open arms and help you in your trading there as well. So we want to start out this discussion today talking about high probability trades. So when experts predict things, right? Just had the election in the US, and there were experts saying, I think this one's going to win for this reason, and that one's going to win this seat for that reason. But those reasons tend to be backed up by numbers, by statistics. In Las Vegas, sports betting has become pretty big out there, right? In fact, you don't even have to go to Las Vegas. You just grab your phone. There are people who make the odds there to determine, well, what your payout is, which is based on their perception of probability of that team winning. These folks also use statistics to do all that stuff. professional traders and quants use statistics as well. And good non-professional traders like you, right? Because you're here putting in the effort to get as good as you can at this, right? So good non-professional traders also use statistics. Now, when it comes to, political races or Las Vegas odds making, we look at track records, we look at trends and that kind of thing. I mean, I don't do any of that stuff. When it comes to trading, we have some very specific tools that can help us understand what our probability of success is. And that is option pricing. And there are a few inputs that go into option pricing. And one of them is volatility. Now, volatility can mean different things in different contexts when we talk about options trading. At its most understandable and basic level, volatility is historical volatility, meaning the volatility of the actual stock price itself. They take the closing prices from the past month or so, and they find the standard deviation of those closing prices. Now, if you are not familiar with that term, standard deviation, it's actually kind of self-descriptive when you think about it. If you took like all the kids in a 5th grade class, right? And you took all their heights and you found the average or the mean, which is what statisticians would say. They wouldn't say average, they'd say mean. And then you say, okay, well, this is the average height, and some are a little taller than that, and some are a little shorter than that. And then you got this one kid who like had some major growth spurt and is super tall. And you have this other kid who hasn't hit the growth spurt yet. And, maybe has parents who are vertically challenged and is a shorty. You probably only have like, one or so of the super tall or super not tall ones. So we measure how deviant from the mean each of those kids is, and we draw a probability curve. As you can see, this is the probability, like this middle part is the mean or average. And this is the height of this is the probability of the kid in the class being at this, where my arrow is here, being average. And that the most likely thing is they're probably pretty close to average. Some are shorter, maybe one kid's a lot shorter. Some are taller, maybe one kid's a lot taller. So we're measuring and we're standardizing the deviations from the mean. Now, between up and down one standard deviation, about 68% of those kids are going to be between down one standard deviation and up one standard deviation. All right, so now we can stop talking about kids in the 5th grade class. We can start talking about stocks, and it's the same thing. You take a stock or an ETF, and you say, what were the closing prices of this stock or this ETF over the past month? And let's find the average, the mean, and then let's find the standard deviation. And that standard deviation is what we call the historical volatility, or the realized volatility. Those are synonyms. So the historical volatility is just the standard deviation of the closing prices of that stock or ETF over the past month. And that one's a pretty simple one. Now, when it comes to more stuff with option trading, we also would say we have what's called implied volatility. Now, implied volatility, goodness, I could do a 5-hour class on that. I could do a 3-day class on that. So I'm going to give you the Cliffs Notes for those of you who remember what Cliffs Notes are. I think there's some new version of Cliffs Notes now, right? What do the kids use? Oh, well, actually, they just use ChatGPT now, right? Yeah, we don't need Cliffs Notes. So let me give you the ChatGPT digest of what implied volatility is. There's an assumption that the people buy and sell options for the purpose of, well, with one of their assumptions being how volatile the stock will be in the future. For example, if there is a stock that barely ever moves, it's been in like a 3% range for the past 6 months. If you own that stock and there's no news pending or anything, are you going to rush out and buy puts on it to hedge it and protect it? Probably not, right? What you might consider doing is selling options on it, because as long as it doesn't go through the strike price, you make money. So if the stocks don't move a lot, if we expect them to not have a lot of volatility in the future, then people are more apt to sell options rather than to buy them. Why would you want to buy them if it's not going to move? You just lose money on time decay, right? But the other side of that is, if we believe that the stocks will move a lot, well, that's when we're much more likely to buy puts to protect the stock, to buy calls instead of buying the stock, to have less skin in the game, but still similar profit to the upside, or buy straddles. When we believe volatility will increase, we're more likely to buy options. When we believe stocks are more likely to experience lower volatility in the future, we're more likely to sell options. So that brings us to the strategy we're going to talk about today, right now. Income trades. So income trades, they're basically option selling strategies. And we set them up in such a way where they're naturally high probability trades by nature. We can, just like any good statistician, whether that's a Vegas odds maker, a political scientist or statistician, or a trader, we can have measurable predictive results. Okay, meaning we can assign an actual probability to our likelihood of success. And when it comes to income trades, there are several different option strategies that are within that family of income trades. Namely, the one we're going to talk about right now is credit spreads. Let's talk about the idea of selling options. So when we sell options, again, why do we sell them? Because we perceive that there's likely to be little volatility in the future. So we sell them short with the objective of buying them back later at a lower price. In theory, we could even just sell them and let them expire. So how do we make money? Well, in addition to the idea of implied volatility and historical volatility, we have other factors that affect the value of option prices too. Direction and time passing are the two biggest ones. As time passes, options lose a little bit of their value as each day passes. So So we're looking to profit from the time decay feature of options. We're going to watch them get worth less and less as each day passes. And that makes us smile because then we can buy them back at a lower price. Now, there are risks when it comes to selling options. And one of those is direction, which I just mentioned. If the stock goes the wrong way, like basically what we want to do is we want to sell an option and we want it to expire worthless, or at least aim towards expiring worthless, where we might step up in front of that and close it before it actually expires, right? Make money on time decay. But it might not expire, it might get assigned, right? If that option, hey, Deja is here. Well, it seems like I saw you earlier. So anyway, what could happen is if the option becomes in the money, it starts gaining value instead of losing value as a result of delta, which we'll talk about a little bit more later. And then just volatility. If it moves too much, I mean, that's related to direction. But if it moves like way too much, if I just sell a call, I could lose infinitely. I mean, the stock can go up to infinity as far as in theory goes. So I don't necessarily love the idea of just selling a naked call and hoping it expires, but there's a solution to it, and that is the credit spread. And there's two types of those. Let's start out with the call credit spread. Call credit spread is when a trader sells a call, which is usually out of the money, and then buys a higher strike call with the same expiration on the same underlying. So basically, you've got two options here, right? Two calls. One you sell, and that one's closer to the stock price. Remember, we're buying a higher strike further out of the money. So the option you sell is the one that you hope to make your money on. That's the one that you will make or lose money on. That's like the trade. The option you're buying is the insurance policy. Because if you put on this, if you just sell a call and the next day the company announces that it's being bought by another company for 20% higher price, you can lose your shorts. So if you buy that higher strike call, you now have limited loss. And we're going to look at that in a second. So the short option is the trade where you'll make or lose money. The long option is the insurance policy. Now let's look at put credit spread. That is when I sell a put that's usually out of the money. So the strike price is below the stock price. And then I buy a lower strike put on the same expiration, on the same underlying. So when I do that, what happens? It's the exact same thing. The short put is the trade. That's where, I hope to make money on time passing and not lose money by the stock going down through the strike price. Short option is the trade, and the long option is the insurance policy. If you just sell a put and the next day a news article comes out that says the CFO was cooking the books and now the stock is worth half what it was yesterday, you can lose a lot of money. But with the put credit spread, you have that built-in protection. Now, there is a case for selling puts not as part of a spread, and I think we did a class on that already. So the way I look at it is selling cash secured puts where I have the cash in case I get assigned. I look at that as a way into a long-term stock investment or ETF investment. Whereas the put credit spread, I look at that as more of a trader's strategy. The short term, I'm not trying to get assigned. I'm trying to skate. I'm just trying to sell it and buy it back later. at a lower price. So with the call credit spread, it kind of works like this. We have the short strike, right? Maybe I'm selling maybe there's a stock that's at $100 and I'm selling the 105 calls and buying the what did I say, 105, and buying the 107 calls. As long as the stock stays, if the stock, which is at 100, goes lower, it's fine, I win. These are moving towards expiring, right? If it stays at 100, that's fine, I win. Even if it goes up to 104.99, I still win. If it goes up over the 105 strike and we hold it all the way to expiration, do nothing, then that short call would get assigned and I would be short stock, which means the higher it goes, the worse it is. Now, I would sell the stock at 105 if I got assigned. But when I sold that spread, sold the 105, 107 call credit spread, I sold it for some amount of money. Maybe that's 70 cents. So if I were to actually get assigned and sell short the stock at 105, I would want to kind of factor in that 70 cents that I collected on the spread. So my break even or my effective short price on the stock would be 105.70. Now, if it keeps going up, that kind of stinks. But if it goes up above 107, the long call strike, then I can exercise that long call buying back what I sold short at effectively 105.70. Buy that back at $107. And so my maximum loss would be $130. Steven says, what if you do this with SPY, SPY, but you only have 10K in the bank account? That's a great question. Well, let's see. What price are spiders right now? What price is SPY right now? 607. Okay. So let's say you sell the 610 calls and buy the 612 calls. Okay. $610 strike, you sell. $605 strike, you buy. Wait. Sell the 610, buy the 612, right? And let's say you can sell that for 60 cents. How much? Okay, let's see who's paying attention here. How much is the most I can make? If I sell that spread at 60 cents, how much is the most I can make? And I just do one contract. Sell one of the 610 calls, buy one of the 612 calls, sell them at 60 cents of option premium, hold it all the way until expiration, and it expires. Aslam, boom. Paying attention. You're always Johnny on the spot here, Aslam. I love that. Show up week after week and you get the answers right. That's great. The most you can make is $60. Why? Because you sold that one spread at 60 cents of option premium, which is $60 of money. And if the both options expire, then the options are gone, but I get to keep the $60. Okay. Who can tell me this? And I kind of already just went through this exercise, but let's see how well you got it. What's the most I can lose? Sold the 610 calls, bought the 612 calls, collected 60 cents. What is the most I can lose on that trade? Who can tell me? $1.40, Manish, boom, coming out of the woodwork here. Yeah, man, $140. That's right. Why? Because if I got assigned and sold spiders at 610, but I collected 60 cents. That's like really like selling it at 610.60 and then buying it back at 612. So 612 minus 610.60 is $1.40 of option premium, which is $140 of money. So Stephen's question was, what if you do this with SPY, but you only have 10K in the account? The most you can lose on that is $140. So you're fine. If you do a 10 lot, the most you could lose is $1,400. So you've got plenty of extra capital there. I always like to tell people you should, I mean, if you have a big account, I definitely don't like to see you putting any more than 5% of your margin on any one trade. If you got a really small account, sometimes that's hard to do. I don't like to see you doing more than 10% margin. And by the way, that is what your broker will require you to put up, is margin to make this trade. And with the credit spread, the margin is the most you can lose. So brokers will not really assign, they will just keep the spread loss. No, that's not. So the brokers don't do the assignment. When you sell that 610 call, you're selling it to another human. And the other human is buying the call from you. Now, don't get me wrong, that human might have created an algorithm that automatically enters orders or whatever, but that person will have that long 610 call in their account and that short 612 call in your account. They're going to have the opposite position of you. So if you get assigned and have to sell the stock short, that's because a human somewhere in the world who was long that call, who has the right to buy that stock from someone who's shorted, exercised it. So you get assigned not when your broker wants to do it. You get assigned when a human somewhere in the world makes the decision to exercise the long. And they will do that. If it is expiration day, at the end of the day, if the stock or ETF in this case is a penny or more in the money, the OCC will automatically exercise it. So you should assume that you're going to get assigned if you hold it all the way till expiration and it's in the money even by a penny. Now, could you get assigned early? Yes, that's more likely with puts than calls for various reasons that are out of the scope of this class here today. But one thing to consider here though is I like to give the guidance that you should never hold any trade all the way until expiration. You should always close it before expiration. At some point, the risk reward is no longer favorable, and you would not want to continue holding it. All right, good questions. Lively discussion. So what are some things that can go right and can go wrong? What are some tools that we can use? Well, for credit spreads, we want to start out with the discussion of delta. What is delta? Delta is one of the option Greeks. I bet you knew that that was a Greek letter, didn't you? Delta is one of the option Greeks, and the actual definition of it is it's the rate of change of an option position's value relative to the change in the stock price. So with the call credit spread, as you can see, we don't want it to go up too much. It's okay if it goes down. That just makes it more likely for us to win. So this is basically a negative delta. We prefer the stock to go down, and we could get hurt if it goes up. So call credit spreads would have a negative delta. But there is another definition And that's what I call the trader's definition. And that definition of delta is it's the likelihood of an option to expire in the money. And that definition is not necessarily mathematically accurate, but a lot of traders use it as a loose rule of thumb. We're going to explore that in a second. But JP just asked the question, is it advisable to sell a stock that is doing nothing and start options? Well, I mean, I would want, JP, I would want to go into a more specific example, which we can do at the end in a more like looser Q&A period. But I did a class here with Firstrade on covered calls and stocks that are doing nothing that I own. I love doing covered calls on. Or if you own it, maybe you don't want to sell it because it's paying a dividend, or you thinking, maybe it'll be a sleeper for the next 6 months, but after that, it might take off. I keep those in my IRA, my investments, and my trades, I keep in a trading account. So I might just leave that stock that I'm in for the long term in my investment account. Don't even look at it, pretend I can't see it. And I might sell credit spreads on that stock in a different account. Jun says, how do you decide to close the options? Since at some point, the reward of holding isn't worth the risk anymore. Thanks. So here's what I do. When I put in a credit spread, what I do is, sorry for, I'm actually out of town in Beaver Creek at the ski resort. I'm having some problems with the altitude. And I'm just like, all congested and such. So that's why I have a different backdrop than I usually have out the condo window here. So, John, here's what I do. Let's say I sell a credit spread for 60 cents, and maybe I sell a 10. What I'll do is I'll put in a GTC, good till cancel, order to close it at maybe 40% of my maximum profit. So my maximum profit is 60 cents. What's 40% of 60 cents? That's 24 cents. So 60 minus 24 is 36. I'll put it in order to buy half of them, 5, at 36 cents. GTC, good till cancel, or GT90, good till the next 90 days, or if it gets filled. Or what I'll do is, what I'll do is I'll also put in a second GT90 order to close for a bigger profit, maybe 60% profit. So 60% of my max profit, which is 60 cents, is 36 cents. So 60 minus 36 is 24. So I'd put in order to buy the other 5 lot at 24 cents. So that's a lot earlier profit taking than a lot of people do. But when you get down, like you sell it for 60 cents, and like, let's say the stock goes down or the ETF goes down a bit, and I can buy that back at 10 cents and there's still a week until expiration. Well, what am I going to do? Wait a whole week to make an extra $10 a contract, $100, and I'm going to keep tied up all that margin money, $140 or whatever, doesn't really make any sense. Why tie up $140 to make $10? Why don't I just close it, take that profit, and put on a trade where I can make more than $10 in that same period of time? So yeah, a good rule to go by is scale out first 50% at 40% of the max profit, next 50% at 60% of the max profit. That's a good starting point, depending on your risk tolerance and capitalization and your perceived quality of the trade. You know, those numbers could be slightly, those numbers will be different for everybody, but it's pretty good baseline. All right, so how do we use delta to predict success? Well, let's say we're doing a put credit spread here, okay? So I'm selling a put that's out of the money and buying a lower strike put. Now here, hold on a second. 1 second here. Change this example to call, just because we were doing calls earlier. So let's say I sell a call, it's out of money, that has a 32 delta. Okay. So what does that mean? I sell the call that has a 32 delta. Oh, sorry. Let me make this a little bit different example. All right. I sell a call that has a 32 delta, but it's only part of a call credit spread. So the short call that has a 32 delta, I've also got a long call. I bought a higher strike call that has a 14 delta. Okay, so what do I glean from this? Well, if the stock goes up, it's going to go through the short call first. And if it goes through the short call, I start getting into trouble. So I care about the short calls delta, and I don't really care about the long calls delta at all. So if the trader's definition of delta is it's the likelihood of an option expiring in the money, when I first put on this trade, the call's out of the money. We want it to stay out of the money. If it goes in the money, that's where I can start losing. And there's a 32% chance of that happening. So my chances of losing on this trade is about 32%. So my chances of winning is about 68%. See how that works? Again, this is not really mathematically accurate, but every option trader I know thinks of delta that way as a loose rule of thumb. Aslam says, do you have a set rule to sell a call at a certain delta? No, that is a poor way to set your strikes. And I know that a lot of people set their strikes that way, and I know why. Mainly it's because on backtesting models, you're only able to choose a strike. You can't use support or resistance on backtesting models because it's very, very, very difficult to program. So backtesting models will use delta, and so consequently traders will say, oh, well, that's how I'm supposed to set my strikes. Use always sell a 30 delta or 25 delta or 40 delta. But really, the price of the option and the delta, there's a direct relationship there. The further out of the money and the smaller the delta, the less money you take in. And the more you can lose on those spreads too. Further out of the money, it's lower reward and higher risk. And if the delta is bigger, we collect more and we can lose less. So like delta is just it. If you believe in the options pricing model, and if you're trading options, I hope you believe in the options pricing model, because otherwise you're trading at a massive disadvantage. If you believe in the options pricing model, that means that selling any one delta as a rule is that there is by definition no advantage to it. So what I do is I set support and resistance lines. For call credit spreads, if there's resistance, like a point where the stock got up to but couldn't get through, so it came back down, and it got up to that point again and it couldn't get through, so it came back down, it's called resistance. And that actually does give you an actual advantage. A small advantage. I mean, resistance can be broken, but if it's held in the past, there's more of a likelihood of it holding again. So you're putting statistics on your side when you use resistance. And with put credit spreads, you use support for the same reason. Very good question, and I'm very glad you asked that, Osman. Okay, so the exposure of credit spreads. And by exposure, I mean ways to make money, ways to lose money. Well, first of all, there's delta. If it's a call credit spread, if it goes up too much, I lose. If it goes down, great. I win. With volatility, there's Vega, which is a measure of how much you make or lose as implied volatility changes. Now, that's a pretty small concern. The one that always benefits you, so I didn't even put it here because I think it's kind of assumed, but as far as exposure goes, this is just beneficial exposure, is theta, time decay. That always helps you. Okay, so here's some guidelines. Always know your max gain and your max loss. And if you get in the habit of drawing those P&L diagrams that I showed you, like this, if you just get in the habit of drawing them out by hand, you are going to benefit greatly from that skill. So always know your max gain. And by the way, if you don't know how to draw those, remember I said go to markettaker.com and click on the top right, join free. There's a whole class in there that shows you how to draw P&L diagrams for every common option strategy. We want to make this a high probability trade. And as long as we're selling out of the money options, it naturally is a high probability trade. And if you just think of delta as the loose rule of thumb as to the likelihood of success of the trade, the delta of the short option is always going to be less than 50, which means you have less than a 50% chance of losing. It's high probability by definition, by nature. We want 1 week or even less sometimes until expiration, and no more than 6 weeks until expiration. Once you get more than 6 weeks, the theta is just too small and it's just not worth it anymore. And we want no earnings or other major news expected before expiration. Sometimes these Fed announcements can be really big deals that can move the stock around a lot. If the Fed announcement is tomorrow, you might not really trade as many credit spreads. Okay, how do we set this up? Well, we start with direction. Like I said, like Osmo and I were talking about, we find a stock that has hit support or resistance and bounced off. We use support or resistance levels to set the potential short options strike price. So as I'm looking at stock charts, if I see one that has support and resistance, it's going to just trigger in my brain, oh, maybe this is a good candidate for a credit spread. If it's resistance, call a credit spread. If it's support, put credit spread. Then we move on to volatility. We want to see if the implied volatility is elevated and only trade the credit spread if it is. Now, you may or may not have access to any software packages that analyze volatility. And if you don't, that's, it's not the end of the world. We really prefer to only sell these when volatility is elevated because it gives you an extra edge, an extra advantage. But if you don't have access to those tools, then you don't have access to them. It's fine. So here is a chart. And as you can see here, at $235 a share, we have resistance. Oh, hold on a second here. At $235 a share, we have resistance. It got up there and then it bounced right back down. Got up there, bounced right back down. Got up there, and now we're thinking, hey, you know what? This might be a good one for this. Maybe a nice call credit spread. Then we cross-check with volatility. Ideally, only sell the spread if IV is elevated. How do we know? Well, if we can get a volatility chart, you can Google some free services online to find volatility charts. We look and see if today's implied volatility is in the top half or the bottom half of the 6-month range. If it's in the top half, that's one indication that implied volatility is elevated. Secondly, if today's implied volatility is above today's historical volatility, that's a second indication that implied volatility might be elevated. And then if there are no events scheduled that can cause implied or historical volatility to rise, if all three of those conditions are met, implied volatility is elevated and I get a benefit out of it. So here in this example, remember resistance was at 235. And so we would want to sell the short strike at 235 or higher. And I always look at the 235, 237.5, look at the 237.5, 240, look at the 240, 242.5. And I like to get as far away from the money as I can while still getting a decent enough premium. And how do I define decent enough premium? I take the difference between the two strike prices, in this case, 242.5 minus 240, it's $2.50. And I take 10% of that. And as long as I can get at least 10% of the strike width, so in this case, 25 cents, I think that that's okay. I can get more, I can get 59 cents. So, this is a pretty solid trade. So I'm selling the 240 calls, buying the 242.5 calls. I collect 59 cents. So basically, as long as the stock stays below $240 between now and expiration, I win. If I were to let it expire, the most I could make is 59 cents. But to the point of the conversation I was having with Aslam, was that Aslam? Was that who we were talking about, or was that John? I forget. I'm going to close it before expiration. So I probably won't make 59 cents. Maybe I'll make 50 cents or 45 cents if I close it earlier. I close it earlier too if it goes up through the short strike, because I don't want to lose 241. I'd rather limit my losses to 30 cents, 35 cents, 40 cents, right? If these are high probability trades, if I make 40 cents on every trade and lose 40 cents on every losing trade, and I have more winning trades than losing trades, I've got a recipe for profit, right? So as long as we stay below 240, everything is unicorns and rainbows. If we go up above 240, that's where I start sweating. What I do is I set an alert. Hey, if the stock goes up above 240, send me an alert. SMS message, email, push message, pop up on my browser window. And if it goes above 240, I want to close this sucker. because 240.59 is my break even at expiration. So even if I have to take a dime loss, buy it back at 69 cents or 70 cents, it's fine. I'd rather do that than risk losing 241 because you have disproportionate risk reward. But here's something that's really interesting. My maximum profit is the premium I collect. My maximum loss is the difference between the two strike prices minus the premium I collect, which means the bigger credit I get, the bigger my max profit. But since it's always a function of the two expirations or the two strike prices, the bigger my max profit means the smaller my max loss, right? So it's really important to try and get those bigger premiums on this. Okay, so a couple of takeaways, and then I'm going to open this up to a less formal or a more formal Q&A period. First of all, how do we trade these? It's a pretty simple series of analyses. These are, they're not really bullish and bearish trades, but they are directionally biased. With support, if there's support with put spreads or resistance with call spreads, we've got an edge on our side. If the volatility is elevated, we've got another edge on our side. And then the sanity check. How do the prices line up? If the strikes are $2.50 apart, can I collect more than 10% of that? Can I collect more than 25 cents? If I'm only collecting a nickel, then I can make 5 cents and lose 245. Like that doesn't make any sense at all. That's why I call it a sanity check. And then have a plan. As soon as I get filled and have a position on, like if I put in an order to sell that spread at whatever price, as soon as I get filled, the first thing I do is I go in and put in those GTC closing orders to take my profit, usually scale out. First half at 40% of the max, second half at 60% of the max. And then the next thing I do is I set an alert to give me a message if the stock goes through the short strike price. Plan's all baked in, it's set, and there's no stress. It's easy. I should have more winning trades than losing trades because it's high probability, but I will have some losing trades, and that's okay. What expiration do I choose? Yeah, so I mentioned that a little bit earlier. 6 weeks to the high side. I almost never go out more than 6 weeks, but I'll go down to a week, sometimes less than a week, actually. I've actually put some of these on as 0 DTE trades. Put them on in the morning and they expire today. So good question. Good question. What other questions can I answer for you before we call it a day here, friends? Steven, going back to SPY with the $10,000 account, I'm 50K short of being assigned. Oh, that's why you're asking that question. Yeah, because, right. So if you get assigned, you're right, you're not going to have enough cash in the account. So the broker, remember, the broker is not the one that assigns you. There's someone somewhere in the world that decides to exercise. And then the Options Clearing Corporation says, hey, Firstrade, one of your customers is getting assigned, and Firstrade's basically metaphorically spins a big wheel and it's you. And if you do get assigned, what they will do is they'll assign you because they legally have to. And then they're going to tell you, you have to close this right now, today. You will get a margin call from the compliance department or whoever. And if you don't sell it, they will sell it for you. But look, you should very, very seldom run into that problem, because if the stock goes through the short strike price and the short strike price becomes in the money, you need to manage your risk and close that trade anyway. So, I mean, I cannot remember the last time I got assigned on a credit spread. I can't even remember. It's been at least a decade. It can happen if there's a big, massive gap. I mean, with SPY, that should never happen. You'd be doing a very bad job managing your risk if it happens with SPY. But, some smaller company that gets taken over by a bigger company, with a surprise announcement that just massively gaps higher overnight, that could happen. So that's why you always want to close your trades before expiration. Don't be afraid to take losses if the stock goes through the short strike price, because it's better than getting assigned to take a little tiny loss, and it's better than taking your max loss to take a little tiny loss. So good question. I didn't pick up on that being the reason you asked earlier. Thanks. JP, where can I find a good options course for beginners, hopefully with a mentor that will take me from zero? How much should I expect to pay? Well, market taker mentoring is option trader education. And we work very, very hard for our students. And so I know I'm biased, but I can vouch for the quality of our classes because I work tirelessly and all our coaches work tirelessly. Our entire staff works tirelessly. So, you can email me, JP, offline. I'm just Dan@markettaker.com. Here, I'll type my answer here. Dan@markettaker.com. And we can just email me and we can take this conversation offline. All right. John says, could you repeat your answer on rule to sell a call at a certain delta? Yeah, don't focus on delta. Instead, set your strike prices at or further away from the money from support or resistance. Don't focus on delta, because the options pricing model ensures that no one delta is superior to sell than another one. Like, it guarantees that. The more favorable the delta, the less favorable the risk reward, and vice versa. And what do you think about selling a call credit spread on MSTR? Oh boy. Being out of town here, ski resort and such, I have not been trading. I make it a rule to not trade on vacation. So I haven't looked at MSTR in a couple days anyway. But that one has a lot of upside potential. So you kind of have to be pretty careful with that. But, that said, oh boy, there's actually a whole lot we can talk about with that. That said, with some stocks like MSTR, what you see is the higher the call strike, the higher the implied volatility. That's the opposite of normal. So what that means is when you're selling call credit spreads, you actually get paid a little extra. You get a little extra edge, but that just compensates you for the risk, because, that is a stock that could explode higher. So you got to be like really, really careful. I don't know. 9 times out of 10, I don't play that game. Every once in a while I do, but 9 times out of 10, those really crazy stocks, I stay away from selling credit spreads on. So it's 400. Can I sell a call, the short strike of a call credit spread at 750 or higher, expiring next summer? Next summer. Oh, geez, John, holy crap. That stock could be 2,000 by next summer, or it could be $1 by next summer. Geez, I don't know. That's a scary one, man. I'm not going to say no if you make a case, if you can make a case for it. Yeah, I know. If you can make a case for it, I'm not going to talk you out of anything, I'm definitely not going to talk you into anything either, obviously. But that's a scary one. That is a scary one. What I like to do a lot of the times, this is a really simple analysis that a lot of people don't talk about, but I like to just like, as they say, look to the left, uh, pull up a 1 year and then also a 3 year chart of the stock and say, stock's at 400. Has the stock ever moved? What does that come out to? What percentage is $350 of 400? Like 92%. Can the stock move 92% in 6 months? Has that ever happened as I look to the left? And if it has, then I know, that is definitely not out of the realm of possibility. That's a very simple thing. 5 days, Monday to Friday. It's done that before over a 5 day period. Yeah, man. That's why I say, or sell the 270 put with 1 week to expire. I would only sell a put credit spread. I would not sell a naked put if that was me. There's just way too much risk. Lewis says, what is your opinion on 0DT on SPX? I love it. We have a whole alert service on 0DT on indexes and ETFs. That's like one of the things Market Taker Mentoring specializes in. So I love them, but there's technique to it. Me saying I love it doesn't mean I would go trade it on every single day or something like that. Like there's methodology to it, but that's one of the things we teach. All right, folks. Well, good class, great questions. You guys are like really paying attention. You come back week after week. Oh, I just closed my window here. Awesome. You come back week after week, and I love it. Awesome. Can you share your P&L? P&L? I don't share my P&L. I don't know color underwear I'm wearing too. Come on, man. All right. So have a great rest of your day. I will see you. Oh, geez. I don't know if I'll see you next week. I don't know if we're going to do a webinar next week. I have to talk to the Firstrade folks because we got Christmas and then we've got New Year's Eve. So I am going to follow up and hopefully get a bunch of great new titles. You guys can send me suggestions for topics, dan@markettaker.com, and I'll suggest those to Firstrade, and we'll do it. All right. That being said, have a great rest of your day. This is Dan Passarelli, Trade Smart.